Good afternoon, everybody, and welcome to this edition of our weekly Broker Moves Review for week ending 12 Feb. My name is Carl Capoligua, and I'm the market analyst over here at Think Markets, and it is a pleasure to be with you as we delve into everything broker-related from last week. Now, this edition a little bit late because we typically like to get it out on Friday, the week of, but as we're about to see a massive week in broker moves due to the half-yearly reporting season, which commenced last week. We'll talk about all of that and more after we talk about the Think Markets difference, which is substantial $8 flat rate trades, your own holder identification number, unlimited phone support, and of course no hidden platform or subscription fees. Four fantastic reasons to choose us for your next ASX share trade. The agenda for today, well, let's get straight into it. We're going to talk about all of those things, starting off with upgrades for the week, and brokers typically will have a rating for each company they cover. So, like buy, hold, sell, sometimes recommendations in between those and outside of those. But typically what they recommend their clients do with the stock. They'll also have a price target based upon their valuation for the company, where they think the share price could get to the next sort of 12 to 18 months. For example, Macquarie Group has upgraded their rating on AMP from underperform to neutral as the company reported its full year result. They also increased their price target from 130 to 145. That's about an 11.5% increase, which is about 9.4% above the current share price. And I guess when you're reading these tables, you want to see this as big as possible, and that's the broker seeing quite a lot of upside in it. So this one is Citigroup on Mount Gibson Iron. They've gone from neutral to buy. Obviously, that's far stronger than a neutral rating, for example, with AMP and a few others here. And the price target increase is nice as well, about 9%, but with 32.6% still seen in the upside. That is indicative of a great deal of confidence in Mount Gibson. And it was a December quarter production update that the company reported well ahead of expectations, rolling along nicely with those higher iron ore prices, and Citigroup upgraded their iron ore price expectations more generally, and that led to some earnings increases there for MGX. Look, I'll let you press pause on the screen, and feel free to do that anytime this presentation and review the rest of those. There's so much to get through today, we must keep moving. Challenger Group, they reported their first half results, slightly missed expectations, hence the downgrade here at Macquarie from outperform to neutral. But most brokers did find enough reasons in that result, enough positives in there to upgrade their price target. We can see Macquarie Group, whilst they did downgrade the rating, we've got a 37% increase in the target, but that is actually above where the share price is trading right now. Macquarie said that the company's life division was the key underperformer, but they did see some strength in the funds management division, and they, feeling that could continue down the track, hence the price target increase. CIMIC Group, that got a downgrade there from outperform to neutral, and quite a large price target decrease, 35.6%. from Credit Suisse. Now, this one also had first half results out, and Credit Suisse in particular here disappointed by the weak result, noting that it was compounded by a number of one-offs, generally pandemic related, and just a poor performance in general on their cash flows. And probably most concerning for Credit Suisse was the really weak guidance that the company provided. Look, there's some positives in there, but generally not enough to stave off that downgrade and price target decrease. Credit Suisse also downgraded Galaxy from neutral to underperform, but a massive price target increase here as the company reported their quarterly production results. Credit Suisse said that the results were commendable and quite happy with the results, but just the recent run-up in the share price left it a little bit begging on the valuation side of things. So the rating has come down, but obviously the company's performing well. So the price target has gone up, and whilst it is a big increase in the price target, it's still actually below the current price of the shares. Okay, let's have a look at the price target increases. So the ratings were maintained here, but we saw a change in the price targets. Boral reported actually a really very strong result underpinned by this building boom that we're experiencing at the moment. But there was a little bit of bad news in there on Sydney apartment sales, obviously being impacted by the lack of migration we're experiencing at the moment due to COVID. Nonetheless, we did see some good price target increases here from the brokers covered, with Citigroup seeing about 13.3% upside and a buy, and Morgan Stanley with about 19% upside and an overweight, the most bullish of those brokers. Heading into the next page, Commonwealth Bank came out with their half-yearly reports. Cash earnings down by about 10.8% to 3.9 billion, a little bit less than the 4 and a bit billion market was expecting, but the company announced they would increase their dividends. That made a few investors happy, because obviously we've had a number of companies withdraw their dividends due to the COVID pandemic. So good to see Commonwealth Bank having the confidence to come out there with a $1.50 dividend, and that was better than the $1.45 the market was expecting. CEO Matt Cohen a little bit circumspect about the Australian economy, saying that their estimates were a bit more bearish than the Reserve Bank, and whilst the business was performing well, they're still concerned about the risks to the economy from the pandemic. We talked a little bit about Challenger Group earlier on. Some nice price target increases there on that improvement in the funds management section, but generally at or about where the share price is. So more of a catch up than anything else, and just the one outperform there from Credit Suisse. Looking down the list again into Downer Group. They also reported their half-yearly results, the company experiencing a 17% drop in their interim profit. CEO Grant Fenn said that the main areas of growth and spending that they're seeing at the moment is coming from government. So we have had this talk about this infrastructure boom. They said that Downer is well placed to take advantage of that. Brokers, generally positive on the result overall, looking forward, of course, not backwards to the decrease in profits, and some nice price target increases here, and still a bit of upside seen from at least 3 or really 4 of those brokers, and with the buy, outperform, and overweight, certainly one worth your investigation, I would suggest. GUD reported their half-yearly results as well, generally getting some small price target increases from the brokers, but what's more important is how much they see left in it, and brokers again quite positive, buy, outperform, one neutral, one hold. Macquarie Bank, I do remember they said that the profit result was about 12% better than what they were expecting. They saw some good performances in the automotive sector, and the company was controlling their costs well, but also their ability to increase their prices was a big positive as well. And Macquarie also noting that they expect those strong conditions to continue for the rest of FY21, and some of the recent acquisitions would likely also flow into the bottom line. Insurance Australia Group getting a few price target increases here, a little bit of upside seen at Citigroup and UBS, not so excited Macquarie Group and Morgan Stanley. We do have a couple of buys there at the more positive brokers. The company reported a return to profitability in the last half, a 283 million profit compared to the 460 million loss in the previous half. Big impact from one-off write-downs due to the pandemic, about $1 billion worth of write-downs there. So that means that underlying cash earnings were better by around about 20%. Margins were better as the insurance company increased premiums. They said they were going to pay a 7-cent dividend, which, considering they withheld the dividend in the previous period, is a sign that the company is becoming increasingly confident with their current situation. No franking on that one. It was still the lowest dividend since 2012. James Hardie, we can see a number of price target increases here, the biggest coming from Macquarie with still 36% upside seen in it, but generally brokers quite positive there with outperforms, accumulates and overweights. It was a particularly strong result, 50% increase in their December quarter profits, 20% rise in revenues compared to the previous corresponding periods, 16% above consensus, and guidance also increased by about 11%. In addition, the company is going to pay a 70-cent special dividend, so I would suggest that is about as good as you can get. Heading into the next page, Macquarie Group came out with their December quarter results. Brokers generally positive on the news, but not so positive on the stock, as we can see from where those price targets are in relation to the current price and some of those ratings. Looking down the list, we'll do News Corp a little later on when we do our stocks are focused. REA Group, we saw again some nice price target increases here, so a strong response to the news, but overall brokers are fairly neutral on this one, given that it has had a pretty good run up in its share price, but certainly they all respected the fact that it was a very, very strong result. Heading into the final page here, sigh of relief. Suncorp had a pretty good result. Also some nice price target increases with a fair degree of upside still seen in it, the most from Macquarie Group with about 26% and an outperform. Heading into the list of price target decreases now. CIMIC Group, a standout there. Obviously a typo on that one. But otherwise we can see a 35% decline in the price target from Credit Suisse, 9%. From JP Morgan, 16%. At UBS, but still some upside seen in the share price. JP Morgan the most bullish with a buy. Into the next page of decreases. Once again, Magellan Financial Group and Shopping Centres Australia reporting their half-yearly results. We'll just keep this one moving. TCL getting 4 out of 4 price target decreases, but brokers generally still optimistic about this one, given how much upside they still see in it. We've got a buy, an outperform, and a buy in the 3 out of the 4 ratings there. Citigroup did upgrade their rating, don't forget, from sell to neutral. They said the report was slightly above their expectations, but respected the fact that it missed the market's expectations by about 5%. They were optimistic about the company going forward, but they said that there are 3 key factors preventing the broker from getting any more positive than they are. Number 1, the valuation remains elevated compared to long-term averages. There's still potential downside risk from increased work from home habits, and there's still plenty of debt in the business as well. Okay, heading into our stocks of interest today. News Corporation come out with their December quarter update, and UBS very happy, noting they were significantly better than expected. The company was delivering well on its cost-cutting program and its increased operational efficiencies and leverage, so that's their ability to maintain or increase their prices. And UBS remained optimistic about future growth prospects, particularly in digital. That caused them to raise their price target from 29 to 32.20, just over 10%, and a buy rating. And we do note that there's still plenty of upside in that target. Macquarie Group also raised their price target substantially more, 25.55 to 36.10. Which is way up here somewhere, retained their outperform rating. They were impressed with the second quarter results, note better than expected performance and lower costs again. Digital business, once again, also noted as being the outperformer, and continued tailwinds from the COVID pandemic should persist. Some massive increases in their FY 21, 22 and 23 earnings, 47, 41, 27% respectively. Brokers unanimously positive on this one with 6 out of 6 buys. I'm going to suggest that these need to be updated because that doesn't match that, and this data provider does take a few days to collate and then report on some of these changes, but we're reporting on them as they occur. Looking at some of the financials, the enterprise value to revenue is quite respectable, but the PE, I would suggest, is very high at the moment, even though it's going to come down to about 38.52 in FY22. And the growth rate is good. Typically you're looking for a number less than 1 here. Dividend yield, not fantastic. Return on equity, invested capital, not fantastic. It's hard for me to call that one a buy based upon those numbers, but certainly based upon the chart, it is a buy for me. It's a screaming buy. I don't know if I'd pay these prices up around 30. Often you get a little bit of technical resistance around big round numbers like that. What I'd be doing is looking for these moving averages to continue to rise, and then looking for a pullback into what will be what I call a dynamic support zone. So we're sort of around that $27 level. I'd be waiting for an opportunity to buy if I got it, but certainly if you have it, hold on to it. You can't doubt the strength of that short-term trend, and also this long-term trend, very strong and intact. And we'll finish off with a look at AMP. They reported a 30% drop in their underlying profits, down to 177 million for the year, but that is a profit compared to the prior year's $2.5 billion loss, which was riddled with write-downs and one-offs. Revenues from continuing operations, so underlying cash earnings, did fall 15%. That is concerning. Funds continue to flow out of the business, and even worse, there was a takeover on the table at 185 from Aris Management, and that was dropped pre-results report. And you can see the share price tumbling in response to that. Brokers weren't all that happy anyway with their results. Citigroup lowering their price target from 160 to 145, retained their neutral. They blamed lower AMP capital investment earnings. The broker lowered their expected earnings by 16% for FY21 and 19% for FY22. Turnaround, slow going, and the dividends are going to continue to be under pressure. They said that asset sales would help, and without that takeover now on the table, you would expect the management to look very closely at that. Macquarie did upgrade their rating from underperform to neutral. We did talk about this one earlier on, and their price target. They took a more optimistic view of the results, saying that the results, whilst not fantastic, did give the broker at least a little bit of clarity on where the business was, and without that takeover, AMP can now focus on just turning this thing around. UBS lowered their price target from 180 to 145, and that is a substantial drop. They did retain their neutral rating. However, they were not impressed at all with those full year results. They note they were 3% below forecasts, led by a 12.5% fall in performance at AMP Capital. The broker feels that the risks continue to remain to the downside. Looking at where the brokers are at the moment, 5 holds, 1 sell and 1 stronger buy. Absolutely curious to know who that might be. In terms of the mean estimates, we're looking at about 165, which is kind of around here, but I'd expect some of those to drop based upon the updates that will no doubt come through. EV to revenue, not fantastic at all. In fact, it's actually quite terrible, but the PE is still pretty low and potentially dropping as the company does return to some growth here. So that's interesting. A reasonable yield. The business is looking to reinstate the yield, so maybe that might well come to fruition. But with pretty tepid numbers here, I don't think I'm a buyer based upon those fundamentals. I'm certainly not a buyer based upon the broker consensus, and I'm definitely not a buyer based upon the chart, which is showing short-term downtrend, long-term downtrend, technical breakdowns. Maybe there's a little bit of support at 130, but I am definitely not brave enough to find out whether that is the key turnaround level. Well, that's it for me today. Sorry for the length of this session. It did go a little bit longer than usual, but I'm sure you'll agree with me. So much to get through. You can catch all of our other updates on the market news section of the website. You can follow me or the Think Markets handles on Twitter. And of course, don't forget to get onto the webinar section of the website and register for Wednesday's Ask the Experts. Bring your portfolio along and I'll give you a quick fundamental and technical view on any stock you'd like to discuss with us. Also, register for some of these other events we've got coming up as well. Before I leave you, the disclaimer is all important. Everything we've discussed today is general in nature. We are a regulated Australian broker. We do have some products that could see you lose more than your deposit. So before acting upon any of that general advice, please consider these things very carefully or give us a call if you've got any other questions. It's been a pleasure being with you today. All the best for your trading until we catch up again. Bye-bye for now.